ओके तो गुड आफ्टरनून। अभी आज मैं आपको रिस्क एंड मेजरमेंट है ना, दिस इज ए चैप्टर, वेरी वेरी इंपॉर्टेंट चैप्टर of the mutual fund. And when you are preparing for mutual fund examination, then this chapter contains lot of concept and lot of rewarding points. No questions comes very often from this area. Now, what to look into this area? I will take up very briefly and very tersely. No, very terse. See, mutual fund investments of schemes are basically into two types of asset class. The other class, which in fact I am leaving aside, that is a commodity, which is a gold. I am considering right now equity and debt only for my study right now. Okay, leaving aside the commodity. So in equity and debt, the kind of risk that we need to study here are important. Normally, if you say that the risk of equity and the risk of debt is quite long, it's a very big subject. It takes could be a year-long courses for you to completely know about the risk of equity and the risk of debt. But for mutual fund, this is not so difficult. It's very simple. In the segment of equity, you have to study only two types of risk. One is called systematic risk, one is called unsystematic risk. Similarly, in the case of debt, the two risks, that is interest rate risk and the credit risk, these two will take care of your most of the risk. So not much is stressed out here in terms of knowing the risk and its measurement in the mutual fund. Now let us come to the let us concentrate on the equity part. Now what is systematic risk? Systematic risk is risk arising out of the market, arising out of the economy. See, if you are participating in an economy or in a market, you are exposed to the risk. You cannot do away with the risk if you want to invest in that economy or in that market. Say for example, you want to invest in India, you have a high inflation, you have a depreciating currency. You want to invest in America, you have a low growth. So these are the permanent feature of any economy if you want to invest in that economy. That is systematic risk, system driven risk. You cannot do away with that. It is to be there precisely. Okay. So how to measure this? The measuring this is the term called beta. No, beta is the sensitivity. It is a measurement of sensitivity. I will explain you in little detail very soon. The second risk is the unsystematic risk. That risk basically arises out because of investment in one stock, single stock. It's a stock specific risk, security specific risk. Now, suppose you are investing in one stock, you have got both the risk. You have got risk associated with the market, which is economy, I will say, and risk also arising out of the single stock. Fine. Now, in case of mutual fund, no, you do not invest in one stock. You invest in a series of stock that is called portfolio. So the portfolio is basically another word of a diversification. No, so different stocks are there, different numbers of stocks are there, large number of stocks are there, and there is one word called correlation. So this is uncorrelated, means the stocks are inversely correlated, or you can say it is less correlated. No, significantly it reduces the risk. So because you are investing in a portfolio, so this is risk arising on account of single security, which is called unsystematic risk, gets neutralized. Largely it gets neutralized. Fine. So I've written over here the diversification, means if you diversify your portfolio, this risk of unsystematic nature of equity portfolio will get reduced, and it gets reduced significantly. Okay. Now coming to the debt segment. In debt, you will have a series of risks, of course, no doubt about that. But the two risk is going to explain us everything. One is interest rate risk, one is credit risk. Now, what is the interest rate risk? Now, I will show you one slide over here, and that will help you to understand. See, look at this. It's called a yield to maturity curve. Yield is on y-axis. Fine. And on the horizontal side, there is a x-axis. There you have maturity. You can see the maturity in terms of here. You can see my cursor, how my cursors are positioned. Fine. So you will find on the x-axis, the longer the maturity, you will find the curve of the yield. Curve of the yield is going upward. It's a upward sloping. Fine. Take my words very seriously. Upward sloping. So as the maturity progresses, the yield, which is called return also in another simple word, the yield goes up and that is what you can see in the form of slope that it is called upward sloping. So you can conclude here that if the longer is the maturity of the bond, higher is the interest, which is the yield, and higher is the risk. This risk is known as interest rate risk. Fine. So longer bond will have a higher interest rate risk and shorter bond should have a lower interest rate risk. So the definition of interest rate risk can be like this. It's a measurement of change in bond value on account of change in interest rate. Fine. This could be also one definition of this. Means what kind of changes happens in the bond value. You can say portfolio NAV on account of change in the interest rate of the economy. Okay. So interest rate risk is very important. So you can find out that if the bond portfolio of schemes of mutual funds, if you move across all overnight fund to liquid fund to money market fund to ultra short term fund to short term fund to medium term fund to long term fund and to say 10-year GSA constant maturity long term fund, you will find the maturity, average maturity or the duration or the tenure, whatever you say, that keeps going up. And as this maturity goes up, you can safely say interest rate risk goes up. Fine. So to measure this interest rate risk, there is a word called duration. A lot of way we measure this interest rate risk. We have a word called average maturity. We have a word called duration, and this duration is also called as a Mauchly duration. Fine. So we have also one word called modified duration. I will explain you about these three difference in the next video. But right now interest rate risk is measured by duration. That is basically it's a like length. It's a maturity of that bond portfolio in our case for a mutual fund. Fine. Then comes second is the credit risk. What this risk talks about? This risk talks about the difference between the yield of a government bond and a rated bond. Rated bonds means a corporate bond. Every corporate bond are to undergo a rating exercise. Why? Rating means why do we rate a bond? Rating a bond means to identify the credit worthiness of a bond. Rating of a bond is to identify the credit worthiness of a bond. What is this? This is the ability of a borrower to pay back to the lender. No, if I say you are a good credit worthy person, that means your ability to pay back to the lender is quite good. It's handsomely appreciated. Fine. So good credit worthy and bad credit worthy. No, so this way, so you will find one word that I was using right now was government security. So government securities are not rated. It is not rated. Only corporate bonds are rated. Means bond issued by the private lenders. Fine. Bond issued by the private lenders. Fine. So the government bonds, it is assumed that government will always pay you back. Government will not default. They have the utmost, the best credit worthiness. So they are called sovereign, S-O-V. No, sovereign. We identify them by sovereign, and all other bonds are identified by the corporate bonds. So look here in this picture, you can say in the red line on the yield curve, which is the very lower side, you will find this is representing your government security yield. So in different time frame the yield is moving upward sloping. No, so you can see it. But then the blue color, the red color are denoting different kind of bonds. You can find the difference between the rated bond and the government bond. That rate, that spread, that difference, that is called, that spread is called credit spread, or sometimes we call yield spread. Fine. So this basically measures the credit risk. Higher the spread, poor is the bond. Which bond? The government bond. No, the corporate bond. Government bond will remain sovereign. Fine. The higher the spread, and that means the poor is the bond. If you see the government, if you see the bond portfolio has got a poor rated bond or lesser rated bond, that means yield spread will be more. You can see the picture. Yield spread will be more. So yield will be more. So the portfolio return, portfolio yield should be more. So mutual fund does take risk of this nature, and there is a specific scheme called yield credit risk fund. There is also a specific scheme called credit risk fund. In that you will find the bond that they have in the portfolio are not of excellent or highest order of the quality, they are in the mid segment, could be around BB plus or BB. No, they are around that. Why they keep this kind of bond portfolio, bond rating? Because they want to increase the return, they want to increase the yield. Fine. So this is called yield spread, and that yield spread brings you to the concept of credit risk. We measure the credit risk by using credit spread, or yield spread. Fine. So these two are equity and debt portfolios, and the way it is measured, we can see in the picture, as it is being said, total risk is nothing but a systematic risk and non-systematic risk. I explained you the systematic and non-systematic. If you measure that together, that becomes total risk. So for equity also you can say total risk is can be measured. Yeah, for debt also you can measure so many risks, and that all puts together will be called total risk. So total risk is measured by the standard deviation. No, what is this? This is a minimum. This is a deviation from the mean. And deviation from the mean. So any portfolio will have a maxima and minima. No, they have a data point where they have a good performance, bad performance. No, very good performance, very bad performance. So this way you create a data range of last 3 years to find out a standard deviation of that data point. No, this standard deviation is basically that represents the volatility. No, that represents the volatility of that portfolio. So this is a measurement of total risk. Fine. So this is one thing. And one more thing is that about beta. No, I said you beta is for systematic risk, and beta is a measurement of the sensitivity of the equity portfolio. It basically is the ratio between the performance of a scheme with respect to the underlying benchmark. For say example, I am giving you, if say scheme is giving you 10% return. Okay, if a scheme is giving you 10% return and portfolio also giving you 10% return, so 10 by 10, that is 1, that means beta is 1. It's a risk neutral. No, it's a risk neutral. Normally for index fund you will find beta will be 1. It's a passively managed risk neutral fund. No, it's a passively managed open-ended risk neutral fund. Okay, what is passively managed? I will explain you in next video. Fine. And if suppose in next condition your performance of a scheme is 15% up and down, plus and minus either side, and the benchmark is correspondingly plus and minus say 10%. So the ratio here 15 by 10 is 1.5, and you will say it's aggressive scheme. With respect to the movement of market and the benchmark, the scheme goes berserk. No, it moves very fast in the either side. That's a more volatility, aggressive stock, aggressive behavior of a portfolio. And suppose the scheme performance is only 5% with respect to the 10% performance of a benchmark. So you will say, oh, 5 by 10 is only 0.5. So anything which is 0.5 is a defensive portfolio, defensive stock. So you can make out if the beta is equal to 1, that means it's a risk neutral. Almost example could be near about your index fund. If beta is more than 1, you can say it's aggressive scheme. You must buy it provided you can take risk. And if beta is less than 1, that means it is less risky, and it will move a little lesser in terms of volatility with respect to the underlying benchmark. So this way you can understand. This is very short. I could able to tell you about these things. Fine. For more details you have to study about the same things in chapter number 7 and chapter number 3. Very important from this point of view, and I will explain you in more details where we can have some question answer session also while using the classes. Fine. So till now, fine, good luck. Thank you so nice of you.